Okay, so higher level accounting, you were asked to do the interpretation of account for Shannon PLC. Okay, so I'm just going to go through a quick video going through your part A, part B and part C, and then I'll upload then the solution to Microsoft Teams, okay? So the first question is your ratios, okay? So your cash sales if the period of credit given to debtors is 2 months. As we see here, I have it done out. It's very self-explanatory. You put in the 2 months instead of credit sales because you don't know what credit sales are. So you know the answer is 2 months, so you're subbing in the 2 in here to find the credit sales. And then we can minus these two to find out our credit sales. Then if we move down, return on capital employed, very easy. Return on capital employed is your net profit in the question plus interest, which is in the question, over capital employed, which is the very end figure in the balance sheet. And we have our answer there. Very simple. We've done this before. Earnings per share then, we have our net profit after preference dividend. So our net profit minus our 5,000 over 350,000 ordinary shares. Now, this one is one that you may kind of struggle with, okay? So your net profit is 47,000 in the question. So we can see our net profit for the year is 47,000, okay? But you may wonder where the 5,000 come from, the preference dividends. It's a percentage of preference dividends of 5,000. So if you look at the question, you go to preference dividends or preference shares, we'll see they're 5% and there's 100,000 of them. So 100,000 multiplied by 5% is 5,000. So that's your preference dividend is 5,000 over the number of ordinary shares, which is in your question. Our ordinary shares, the amount of them is 350,000. Okay, and that's how you get that. Now the next one, the dividend yield, is a little bit more trickier. So you're asked to find out dividend yield. So the formula for dividend yield is dividends per share over market price multiplied by 100. Now we know what the market price is in the question because the market price is down the very end of the question here, the market value, 130. But however, we don't know what dividend per share is because it's not in our question. So first of all, to answer dividend yield, we need to find out what dividend per share is. Okay, so we go to our formulas, we find out what the formula is for dividends per share. We see it's ordinary dividend over market value multiplied by 100. Okay, now this is where it's a little bit tricky to find out what your ordinary dividend is. So the ordinary dividend is your dividends paid minus the percentage of preference dividends. So in your question, dividends paid is 40,000 minus percentage of preference dividend is, remember we figured out the percentage of preference dividend is 100,000 multiplied by 5% is 5,000. So for your ordinary dividend, you have your 40,000 dividends paid minus your 5,000, which is the percentage of dividends there, so it's 35,000. So ordinary dividend then is 35,000 over market value, so the amount of shares that we have valued for, which is again 350,000, and so we found out that dividends per share is 10 cents. Now that we know what dividends per share is, we can go back to what we were asked to do and answer the dividend yield question, okay? So dividends per share is 10 cents over our market price, which is 130 at the end of the page there, multiply by 100, and we get 7.69%. And then just the last one there, period to recoup price, again our market price we know from the question is 130 over dividend per share is 10 cents is 13 years. Okay, so that's part A. Now part B again is our theory part, but the thing that we see from the question of part B is we're asked to advise the bank manager of a loan. So the first thing we look at there is, we see bank manager. Now we need to answer it using our headings for the bank manager, which is at the very front of our revision booklets. If you look at the front, we have our bank manager headings. So we have the shareholders and state of affairs, and we have the bank manager's one. So in this question we're looking at the bank manager. So we need to use these headings when answering about the bank manager. Okay, and we have a little conclusion. So you'll see yourself, you know what to talk about under the headings. So your headings you got from your booklet, but you talk about the profitability, the liquidity, the gearing, okay, its ability to repay debts, security, and its dividend cover, the sector that it's in is in the construction industry, the purpose of the loan, and the conclusion. So if you're talking about any of these headings, like for example profitability, and you haven't worked out net profit ratio or return on capital employed, but we have worked out return on capital employed, but let's say you haven't, you need to obviously for the question. Then this one here, liquidity, if you remember from part A of this question, we didn't calculate any asset test ratio or any current ratio, so we need to calculate them ourselves now in order to talk about liquidity. So that's just what we have to do. Now just remember, when you're writing about the ratios, going back to the question, you're always looking at your answers for this year's ratios and you're comparing them to last year's, which is up in the top right hand corner of your question. So you see the dividend per share is 12 cents. Let's say it was 10 cents in our question. So you're using the headings, okay, which is in your booklet, for the bank manager, and you're calculating any ratios again which you haven't done, that you have to talk about under the headings. And usually when we talk about them under the headings, we're comparing them to the year before, so our answers compared to the ones from the year before. And then just part C, then you're just asked the difference between, to explain liquidity and solvency. So liquidity, the ability to repay back its debts as they fall due, and solvency is very similar, except for solvency is just the company's overall assets compared to its liabilities that it has. So that's really just another definition there. So I'll pop this video up for you to have a look through it, and I'll also pop the solution up. Okay.